Both Tesla stock and Apple stock are two of the most popular stocks that retail investors have been buying for their portfolio. So here's the million-dollar question. With both stocks down approximately 35% from their all-time highs, which one is the better buy in 2025? Let's time travel together to the future. So Tesla stock closed at $742 per share in December of 2021, but then started to fall with the rest of the market throughout 2022 and ended the year at $109 per share. And Apple stock closed at $178 per share in December of 2021, then fell to $134 per share by the end of the year, which means both stocks were down roughly 35% from their 2021 highs. But then something really interesting happened. Tesla stock continued to go down in 2023 and reached its lowest price target of the year at $101 per share. Meanwhile, Apple stock rebounded nicely from its December lows and made new 52-week highs. In fact, Apple stock hit $190 per share this past October, which was up over 45% from its 2022 low. And I think it's very likely that Apple stock will hit $200 per share by the end of the year. So my first question is, why did Tesla stock keep going down in 2023 when everything else in the market was going back up? And my theory is that this has to do with Elon Musk selling his Tesla stock. In September of 2022, Elon Musk sold 9 and 12 million shares of Tesla stock to pay for his Twitter takeover.
Ow.
And then Elon proceeded to sell another 22 million shares of Tesla stock in chunks throughout the next 3 months. Of course, Tesla stock crashed each time Elon announced a block trade sale, because he dumped so many shares onto the market at once. But I think there's more to the story. I think there are a few institutional investors who had a really good relationship with Elon. They probably called him out directly after the Twitter deal closed and said something like, "Hey Elon, we know you need to sell Tesla stock to pay for your Twitter deal. Can we buy all of those shares off of you for $125 per share?" And Elon says, "Sure." Then these institutions turn around and say to their clients, "Hey, we just bought 30 million shares of Tesla from Elon Musk. It's such a great deal." And then these clients proceed to dump their newly acquired shares of Tesla stock back into the market, which contributes to Tesla crashing even harder. And if you don't believe me, take a look at this chart showing Tesla as daily volume compared to its share price over the last few years. Every time Elon sold a massive amount of stock, Tesla's volume would spike up to the right. This tells us that somebody is actively selling these shares. But the weird thing is that this extra volume doesn't come from other Tesla shareholders. It comes from Elon himself. But anyways, my point is that there is absolutely no way that Apple stock will be trading for less than $130 per share in 2025, and I wouldn't be surprised if it is trading for over $160 per share. So that's an upside potential of 25 to 50% over the next 2 years. But what about Tesla? Well, here's the problem. Tesla stock is up roughly 100% since the beginning of 2023, which makes it the best performing stock of the year. That means that Tesla stock has already rallied hard, while the majority of the stock market is still in a bear market. Tesla stock might not perform well in 2024 is because the stock has already rallied so hard this year. And the second reason is because Tesla stock is super expensive right now. For example, Tesla stock is currently trading at a price-to-sales ratio of 7.66, which is higher than Amazon, Google, and even Apple, which is trading at a price-to-sales ratio of 6.27. And Tesla stock is also extremely expensive relative to its own history. Tesla stock has never traded below a price-to-sales ratio of 4 in the entire company's history. And right now, it's trading at a price-to-sales ratio of nearly 8. So there is clearly a lot of risk baked into Tesla stock at these levels. And speaking of levels, Tesla's stock is trading at an all-time high right now of $911 per share. And when a stock hits a new all-time high before the overall market, it usually signals that the stock has already rallied too much. For example, Nvidia stock hit an all-time high of $1,000 per share in August, but then fell 35% over the next 3 months as the rest of the market caught up. Meanwhile, Apple stock is still $200 away from its all-time highs and $300 away from its previous all-time highs. So Apple stock could easily rally another 50% before it reaches its previous highs, while Tesla stock could only rally 20% before it reaches its all-time high. But my favorite piece of evidence for why Tesla stock might not perform well over the next 2 years is the fact that it's already rallying while interest rates are still going up. And this is really important because historically, growth stocks, especially unprofitable growth stocks like Tesla, tend to crash when interest rates are going up. So what does this all mean? Well, my base case for Tesla stock is that it ends 2025 trading for about where it is right now. It's maybe $850 to $950 per share, which represents a 25 to 40 downside from current levels. I'm not saying that Tesla stock will crash to these levels overnight. It's very likely that it will be choppy sideways throughout 2024 and 2025. But I think it is safe to assume that Tesla stock will be trading for over $1,000 per share by the end of 2025, especially considering that Tesla stock tends to be choppy during election years. And honestly, I think the same thing will happen with Apple stock. I think it will be choppy sideways over the next 2 years. But the key difference between Apple and Tesla is that Apple is actually profitable. So which one should you buy? Well, in a normal market, I would say that Tesla stock is the better buy, because it's a high-growth stock and Apple stock is more of a mature company. But the problem is that we are not in a normal market right now. We're in a market where interest rates are going up, inflation is going up, and people are losing their jobs. And under these circumstances, I always prefer to buy profitable companies over unprofitable companies. In fact, I think that any retail investor can build a portfolio that outperforms Tesla over the long run by simply buying index funds like VOO or SPY and doing nothing. These index funds will give you exposure to all of the top US companies like Tesla and Apple. And they have very low fees and they are very tax efficient. Plus, they have already proven themselves over the last 100 years to be a great long-term investment. Of course, if you want more growth, you can allocate some money to a fund like VGT, which is an index fund that tracks the top US growth stocks. And this fund has returned over 20% per year since its inception 10 years ago. So I think a good asset allocation for a retail investor would be somewhere between 70 to 80% in a total market index fund like VU or SPY, and then 20 to 30% in a growth fund like VGT. And this type of portfolio should do really well over the next 10 years. But anyways, that's just what I think. What do you guys think? Which stock will perform better over the next 2 years? Comment that down below. Also, drop a like if you agree that Tesla stock is overvalued right now. And of course, consider checking out our international channels to watch our videos in other languages, and consider subscribing to see more questions logically answered. But until then, I'll see you guys on the next one.